Thank you everybody for attending. I think Chase and I have been excited to talk about this topic, understanding and tracing and really investigating cryptocurrency. And talking to over 2,000 people, or no, it's 200 people today is really, really fun. And it just really kind of goes to show, how popular this topic is becoming, especially with what's been happening in the news recently. So a couple things I want to talk about just to start. Chase and I, although we are forensic accountants, we're not complete blockchain experts. So we're not going to be talking specifics on the technology and how that works, although we will give a basic, talk about the basic fundamentals of cryptocurrency and blockchain. And really the point of all of this is to kind of gain that fundamental understanding of, how cryptocurrency is used and how we as forensic accountants deal with it within our investigations. And we'll talk a little bit about case examples and challenges that we run into throughout this presentation. So we look forward to this. We want to start with a quick polling question just to get an idea. What industry or profession are you currently working in? We'll take about a minute, let everybody try to think of what industry they're working in. But some people are accountants, but they work at a hospital. Some people might be an attorney that works for a private company, so they're trying to figure that out. But be really interesting. And if you're other, I don't know, maybe it's possible in the chat to indicate, what other industry are you in that isn't on this list? So feel free to do that as well. All right, so majority accounting and finance, interesting. We actually have one legal, so there's one. Very interesting. Okay. So moving on to the next slide, some nonprofit, others in real estate. Excellent. This is great. Well, this is better pictures of Chase and I. You can tell we clean up nice when we want to, but for purposes of today, we look like this. You can see that we're both located in our North Dakota offices. I'm in Fargo, Chase is in Bismarck. I am more your traditional forensic accountant. I have a CPA. I'm also certified in financial forensics, certified fraud examiner, and certified forensic interviewer. And Chase, a little bit different. He is got his CFE just like I do. He's also a cryptocurrency tracing certified examiner, I believe, and a certified cryptocurrency expert. So Chase has a lot more certifications when it comes to this type of thing than I do myself. So one more quick polling question before we move on, because I think this will help us maybe gauge a little bit of the audience here. Does anybody here own any cryptocurrencies at all? Yes, no, maybe. I can see some people being like, I don't know, my spouse maybe buys it. They told me one time they bought a Bitcoin. I don't know. And so maybe you have some, or maybe it's a hard yes or a hard no. We'll give you guys a minute to answer that. All right, so about 20%, and I think 20% own. A couple maybes in there, just like we thought. I think this will benefit everybody. So a lot of no's, which I think this is probably why you're here. I think at the end of the day, everybody that's joined here wants to learn more about this topic, and I think that's excellent that we have a lot of people that are entering here that don't own any cryptocurrency. So with that, I will pass it on to Chase to kind of talk about an overview of crypto.
Thanks, Brett. So that polling question was kind of to gauge the audience to see how in depth we need to go on a lot of things. And so to start off, we're going to have kind of an overview of blockchain, what the technology is, the different types. There's something called consensus algorithms that we'll get into a little bit. And then we're going to get into some of the uses for blockchains, such as cryptocurrencies. And like Brett mentioned, we're not blockchain experts. we're kind of going to go into the basics, but we're not going to go real in depth and be able to answer some of those really specific questions if you might have some. And then from there, we're going to go into cryptocurrency specifically. We're going to talk about the history, kind of how it started, and also get into some of the different types and uses of cryptocurrencies. And then from there, we're going to go into the tracing and blockchain forensics portion and some of the tools, resources that are available, as well as some of the common situations that we're seeing as forensic accountants, and then also some of the challenges of investigating cryptocurrencies. So to start off, what is blockchain? You could Google the word blockchain and you could come up with hundreds of different definitions, and each one is going to be slightly different. And so essentially, just for the purposes of what we're going to be talking about, you can think of a blockchain as a digital ledger that is distributed across a network of computers or nodes. And so think of a digital ledger, just like accountants use a ledger, it's just going to be a digital form that's distributed a bunch of different computers. And this allows the blockchain to be very secure, because to alter or change the blockchain, you would have to alter a lot of those computers. And so if there's 20,000 computers that are part of the Bitcoin network, you would have to alter 10,001 of the information stored on those computers to actually alter the blockchain. So that's part of what makes blockchain so secure and why it's an up and coming technology that is really important to get an understanding of. And so blockchain was actually created in 1991, so about 30 years ago, but it really wasn't utilized until Bitcoin came out in 2008, 2009. So there's quite a big a time gap there between when the concept was developed and when it actually started being utilized. And so, like I mentioned, there's plenty of different types of definitions that you can see. And a lot of it's based on the different types of blockchains. The original vision for blockchain was to be public. It's a public ledger that everybody can see, everybody has access to. And now there are different types of blockchains. There's going to be public, there's private, and then there's kind of hybrid models in between. And so as the blockchain technology became more prevalent, became more popular, there's a lot of different variances between the blockchains. It's important to understand the type of blockchain as well as how it functions. You're going to start to understand how the cryptocurrencies work on the blockchains and some of the uses for the blockchains themselves. So public blockchain is going to be kind of the most common. If you think of Bitcoin, Bitcoin's a public blockchain. And so a lot of the stuff we're going to be talking to, it might not apply to necessarily every single blockchain that exists, but it's going to cover a wide majority of them. Is just going to be kind of the basics. So some of the main consensus algorithms for blockchains are going to be proof of work, proof of stake. You may have heard of delegated proof of stake, and then there's practical Byzantine fault tolerance. And so Bitcoin is an example of a proof of work blockchain. And a proof of work blockchain essentially uses a bunch of different computers or nodes. You may have heard of Bitcoin miners. Those are considered nodes. And so a proof of work blockchain involves a bunch of different computers, miners, and it uses computational power to solve a really complex mathematical problem. And whoever can solve this problem first basically gets rewarded the Bitcoin or other cryptocurrencies, and then that block gets added to the blockchain. And the Bitcoin blockchain, for example, has been criticized for its energy consumption. You may have heard that in the news. And so a lot of the other blockchains that are coming around nowadays are going to be proof of stake blockchains. And the best way to simply describe a proof of stake blockchain is going to be comparing it to a certificate of deposit. So if you have a certificate of deposit, you put in, say, $5,000, you can't touch that $5,000 for 3 months. You still have it, but you can't touch it for 3 months, you can't take it out. But at the end of the 3 months, you get interest. And so that's essentially the way that a proof of stake blockchain operates. And that's the easiest way to think of it when for understanding what we're going to be discussing today. And there's delegated proof of stake. which is just a modified version of proof of stake. I wanted to add that to show that there's variations of all these different types of consensus algorithms. And then there's practical Byzantine fault tolerance, a whole nother different ballgame and type of consensus mechanism. And so these consensus mechanisms basically just, they come to it's the way that the blockchains come to an agreement on the current state of the ledger. And it's the way that, some of the information is verified and distributed throughout the blockchain. So the consensus algorithm is important for knowing the blockchain and the types of cryptocurrencies that you may be dealing with, because on, say, for one of the other blockchains, you could see staking. That doesn't mean that they're sending the cryptocurrency to another wallet. It's a feature that's part of the blockchain. So it's important to understand the different features of the blockchain so you can understand where the cryptocurrencies are going and coming from. And so next, there's native and non-native assets. If you think of the Bitcoin blockchain again, I'm going to be using Bitcoin a lot because that's going to be the most common, the most popular that a lot of people know about. The Bitcoin blockchain, the cryptocurrency on that blockchain is Bitcoin. And so that's going to be the native asset for that blockchain. And if you think of Ethereum, Ether is the native asset of that blockchain, whereas there's going to be other assets or cryptocurrencies that are on blockchains, but they may not be the main asset of that blockchain. And so those will be considered non-native assets. And going into the uses of blockchain, cryptocurrencies is a huge one right now. That seems to be, the primary method that most people are thinking of. And cryptocurrencies themselves have various different functions, purposes, utilities, which we'll kind of discuss later. There's different types as well. But in addition to cryptocurrencies, there's things called smart contracts. There's the distributed ledger itself, which can essentially just be used for supply chains, tracking where assets go, where they're coming from, keeping track of transactions, stuff like that. And then in addition, there's ownership applications. And you've probably heard of the term NFT. It's been in the news a lot lately. An NFT is a non-fungible token. And so the point of NFTs is basically to show ownership. And it's a digital art, digital collectible, something of those sorts usually. And so the blockchain is used just to verify the identity and who owns that digital collectible, for example. And kind of on the same wavelength there, real estate is taking advantage of block state as well. And so recently there have been a couple of examples where an apartment has actually been sold using an NFT. So the physical real life apartment has been sold using the blockchain technology and NFTs. So it's got a lot of different use cases besides just cryptocurrencies. So now we've kind of discussed the basics of blockchain. We're going to talk about cryptocurrency more specifically. So the Bitcoin white paper was published on October 31st, 2008. So it recently just had its 13th year anniversary. And like I'd mentioned before, the idea of Bitcoin was to be decentralized and have a public ledger. And so decentralized means that there's not going to be some central authority regulating the blockchain or determining who's going to be mining on it and all that information. And so it was open source and created by either a group or an individual named Satoshi Nakamoto. And nobody really knows if it's one individual or if it's a group of people. And so it truly is, it was meant to be decentralized, don't even know who made it, open source. And that was kind of the whole idealized concept of cryptocurrencies. Now there are different types. Like I mentioned, there's private blockchains, which can be used for cryptocurrencies. There's a bunch of different variations, but how it started was with the Bitcoin white paper. And so on January 3rd, 2009, that was when the first Bitcoin block was added to the blockchain and it was mined. So just a few months later after the white paper is released. And since then, there have been enormous growth in crypto assets and cryptocurrencies to the point where it's kind of important to differentiate what the purpose of the cryptocurrency is. Is the purpose of the cryptocurrency just to be a hedge against inflation? Is it a security? Is it a governance token, meaning that you're taking part in voting in a company using it? Or is it an NFT where it's just a digital collectible? And so there's a lot of different purposes for cryptocurrencies rather than just investments and being a hedge against inflation. And that's important to understand as well. And so at this point of time, the number of different cryptocurrencies that exist, it's really hard to quantify just due to the growth in the space. I've read several articles, seen several sources in the past few months. All of them indicate, there's more than 10,000 cryptocurrencies, but they really can't give too specific of an amount. But that really shows the growth in the past 10, 12 years, that now there's tens of thousands of cryptocurrencies. And so some of the main ones that you might have heard of are going to be like Bitcoin, Ethereum, Cardano, Monero, Dogecoin. There's also something called stable coins. Those are going to be cryptocurrencies that are usually backed by another asset or pegged to another asset. So there's going to be like Tether and USDC. Those, for example, are always worth $1 US. So you can see there's different purposes of the cryptocurrencies, and USDC and Tether aren't necessarily going to be used for investment purposes since they're always going to be worth $1 US. So now we're going to discuss how do the cryptocurrencies actually work. So as I mentioned before, cryptocurrencies utilize blockchains. And so all the stuff that I mentioned previously about blockchains applies for cryptocurrencies, but we're also going to talk about some of the different aspects involving cryptocurrency. Cryptocurrency has the prefix crypto in it, and that involves cryptography. So one of the key aspects of cryptocurrency is going to be cryptography. So just to touch very briefly on it and not go too far into the nitty gritty of it, there's various different types of cryptography that cryptocurrencies might use. Asymmetric encryption is one of them, and that involves public keys and private keys. And so essentially, a public key is just going to be how you receive cryptocurrency. It's public, everybody can see it. In this case, it could be an address. And so everybody can see that address that they're sending Bitcoin to. But when you get to private keys, this is going to be one of the most important things that people should take away is do not share your private keys. Private keys are needed to decrypt the data for encryption. And in terms of cryptocurrencies, the private keys are how you can access your cryptocurrencies. So if you lose your private key and you had it and you were the only one that was maintaining custody of that cryptocurrency, you're not going to be able to access it. So private keys shouldn't be shared with anyone. They should be written down, stored somewhere safe. And a private key can be a number of different formats. It can be a list of random words, also called a mnemonic phrase or a seed phrase, recovery seed if you've heard that. It could be a string of random numbers and letters because it's something encrypted and you just have the string of letters and digits. It could be a QR code. So there's a bunch of different ways that you can see private keys and public keys, but it's very important to differentiate between the two because a lot of what we've seen and the calls that we've gotten have involved individuals that gave their private keys to an individual who they thought was actually helping them out, who was part of a support for this blockchain. But it turns out it was actually just a fraudster trying to steal the cryptocurrency and they got away with it. And so it's really important to keep your private keys safe. Don't share them with people. Don't put them online. And so since we talked about the public and private keys, those usually involve hashing. And same with the transactions involved on blockchains, they're hashed. And this is just a form of encrypting or encoding the information. And so that's when you see those random letters and random numbers and you can't really make sense of it. That's because it's encrypted information and it's not necessarily supposed to make sense. And so it's important to make sure that you have the right addresses when you're sending cryptocurrency, making sure that it matches to what you're wanting to send it to. Same with the private keys, making sure you have it written down correctly. And so kind of moving into how to send and receive cryptocurrency, wallets are a key component that are involved with cryptocurrencies. and there's numerous different types. So some of the examples are going to be hardware, software, and paper. So a hardware wallet is going to be a physical device. You may have heard of like a ledger or a trezor. And basically the private key is stored on those external devices. And these are used to confirm transactions and send transactions. And then same with putting the public key or the address that you want to send to, those will also be shown on the hardware wallets. Now, a lot of you might have software wallets, and software wallets are going to be the wallets that you download on your phone, your computer, your iPad, stuff like that. A lot of times you'll also be given a private key, and it could be, like I had mentioned, those random 12 words, could be 24 words. It just depends on how the wallet functions and how they give you the private key. But it's important that you get those private keys, because if you, for example, are using an exchange or say a brokerage account and you don't actually have custody of your cryptocurrency, then you really can't control what goes on with that cryptocurrency. There's a term called not your keys, not your crypto. And it's basically just saying if you don't have the private keys to your cryptocurrency, you're really not in control of it. And so maintaining your private keys, making sure it's written down, like I've mentioned several times already, is going to be really important if you're going to be owning any cryptocurrencies. And software wallets and hardware wallets will generally give you those private keys to store somewhere. Paper wallets, on the other hand, are going to be a little bit different. You may have seen around town, wherever you live, something like a cryptocurrency ATM or a Bitcoin ATM. These are ATMs where you can put in cash, fiat currency, and then you receive either, you can transfer it to a wallet of your choosing. You can scan your phone and send it to a digital wallet, or you can get a paper printout. And this is what's considered a paper wallet. On that piece of paper, it'll show generally show the public address, your private keys as well. And sometimes it'll show them as QR codes along with the string of letters. So it's important to understand there's various different ways that cryptocurrency can be held in wallets, because we have had instances where it may involve paper wallets, it may involve a software wallet or a hardware wallet. And so generally they can all be traced the same on the blockchain, but it is kind of important to know, if you know it's stored on paper wallets, you can potentially have more information about where it was bought and all that information. Or if it's a hardware wallet, you can know that a trezor exists and the husband has a trezor that should be considered when in litigation or a divorce or something of that example. So now that we've kind of discussed kind of the basics of blockchains, cryptocurrency, and how it functions, we're going to get now into how to actually trace and utilize blockchain forensics to help us figure out where the cryptocurrencies went and kind of give some examples of the types of situations that we're seeing.
All right, so just kind of piggybacking off Chase. Yeah, so how do we trace this stuff? Why would we trace this stuff? Who's tracing this stuff? Those are the questions that a lot of you want to know. And hopefully we have some of those answers. But I think the big thing that we need to just come to the realization at this point is that cryptocurrency is here. There was a CNBC article recently that indicated that 13% of Americans have purchased cryptocurrency within the last 12 months. Probably similar to what we had in our polling question. There's also at least, it's probably higher now, 80 cryptocurrencies that have market caps over $1 billion. So they have value. They're assets. I mean, people treat Bitcoin as an investment opportunity, and people can utilize cryptocurrency as a means to transact, buy assets, trade assets, and all of that then becomes difficult for people in finance, accounting, from a legal standpoint, for investment purposes for different companies. they're looking at this as an opportunity, and we just need to all come to that realization that if you're in a legal profession, if you're in law enforcement, which shout out to some of the people here that are in law enforcement, I saw that there are a few of you, and if you're in accounting, you're going to deal with this stuff. It's just a matter of time. So because they have value, people are going to fight over them. People are going to steal them, and there's ways to do that. We talked about paper wallets that can be stolen out of a safe. It can be stolen out of someone's wallet, just like cash. These things can happen fairly easily. Things can get hacked, and there have been multiple instances where people have lost their cryptocurrency because it was in a cloud somewhere, and that server got hacked, and they lost it. So there is an increased demand for tracing and investigating what happens to certain cryptocurrency. What was it used for? And it's not all for litigation. And I'll talk about a few examples here. Trust and estates is a good example. And then just businesses and partnerships investing. And then at the end of the day, they want to split up, and they got to figure out, well, what did we buy? One partner was in charge of that, and they invested a bunch of money in cryptocurrency, and they're saying they lost it, or they're saying that we lost a bunch of money in it, or we gained a bunch of money. And people want to know, hey, can you trace that and figure out exactly what happened? So everybody, all the stakeholders, have an idea of what's going on. So moving on, another polling question. Has anyone here ever looked at any blockchain explorer websites? And I'll talk a little bit more on this, but there's certain websites, blockchain.com, blockchair.com, etherscan.io. These are different websites where this is where you can view the open blockchain and view transactions. Has anybody ever tried that before? I'll give you a minute. All right, so a large majority of you have never been to one, which just kind of based on the idea that a lot of you don't own cryptocurrency and probably haven't dealt with it in the past, it makes sense. So we'll talk a little bit about that as we move forward here. But there are three primary tools that we utilize when we investigate or trace crypto. The online tools, the open source blockchain is probably tool number one. Blockchain.com again, blockchair.com, etherscan.io. For the most part, they trace specific coin. Blockchain, the two big ones are the Ethereum blockchain and the Bitcoin blockchain. Those are going to be the ones that people are typically dabbling in. Now, there's other coins on other blockchains that you can utilize, that you can search, but those are the two big ones for the most part. Now, you can view that information. Is that information going to make sense to you? Is the next part. So that's kind of where there's some difficulty, and we'll get into some of the challenges that we face when doing some of this. The other tool that we use is software. CipherTrace, Chainalysis, and Elliptic are probably the leaders in that. Very expensive software. You have a lot of banks that are utilizing this stuff. You have a lot of government entities, FBI, IRS, that utilize these software at their disposal to help trace crypto. And recently, I think it was just last month or in September, CipherTrace was purchased by MasterCard. And CipherTrace was probably the leader of all software as far as tracing cryptocurrency. So when you have MasterCard buying the leading tracing software, it probably gives you an idea of how serious they are in being able to do that. So that's another tool that is utilized when doing these tracing exercises. And then third-party exchanges. So you have Coinbase, and these are some of the big ones: Binance, Kraken, Gemini, Crypto.com. These are places where you can set up an account and purchase cryptocurrency. And by doing so, it's treated very similar to any kind of SEC exchange. Think of downloading a Robinhood app and buying stock. It's not much different in that regard. And by doing that, you're creating somewhat of a paper trail. So that's another resource that we can use. Now, for the most part, we would have to get a subpoena if people don't provide that information willingly, to be able to obtain, someone's personal Coinbase account transactions. So there are some challenges as well when it comes to that type of stuff. But if it's in litigation and we're working on it, a lot of times we can obtain that information. So this is an example, and I just wanted to show this just by way of example, blockchain.com. So when we talked about, have you looked at a blockchain explorer before? This would be an example of what you might see. So if you go to blockchain.com and you were to go click the top where it says Explorer and you type in a wallet address, and you can see at the top that is a wallet address, you might get something that looks like this, or you would in this situation get something that looks like this. So this wallet could be a paper wallet. This could be a software wallet. This could be a hardware wallet. And when you type that information in, you start to get, well, here's the total amount of transactions in that wallet. Here's the total amount of, this is a Bitcoin wallet. So this is the total amount of Bitcoin BTC received, total amount of Bitcoin sent, and then the final balance in that wallet. So this wallet currently has 0.0373691 Bitcoin sitting in it. And then below, you would see all of the transactional information for those 448 transactions. So on the left, the transaction, that would be one transaction where those two wallets, so that top blue number, or I should say that top blue, those characters there, that's the hash representing the transaction where those two wallets below it sent money or sent Bitcoin to all of those other wallets on the right. And you can see in the bottom, it says load more outputs. There's over 1,500 different wallets that money or that Bitcoin transacted with. And that green amount at the very bottom right is what this wallet received as part of that transaction. One other thing to note is on the bottom left, you'll see that there is a fee attached. So when you do make these transactions, there are fees that get charged to you as part of the transaction. And people have to take that into account because some of these fees can get pretty expensive. I won't go into how those fees are calculated. That's probably for a whole nother webinar that I'm not really qualified to give anyway, but just know that information is there and is provided. So common cases that we receive. Family law is probably by far number one that type of cases that we get at this point. And when I say family law, it's typically divorce cases. It could be child payments, and other related type things, trusts, like I kind of mentioned before. But for the most part, it'd be family law, hidden assets. If you have a divorce, and we'll kind of go over an example, and people try to hide money, and one way to do that is to throw it in Bitcoin, where there's not a lot of people that really understand what's going on with that yet. And it can confuse attorneys, it can confuse judges, it can confuse everybody. Do they own that money? Where is it? Do they have it? Nobody knows. Ponzi schemes, investor schemes. We had one case where someone became Facebook friends with an individual, and that individual told them about an initial coin offering that was going to happen, and they wanted to invest. Told them they could make a lot of money. He proceeded to give this individual over 6 figures, lots and lots of money. And that guy defriended him on Facebook and never saw him again. And we've had people that wanted us to help them trace where that money may have went. But when you're sending them cash and they're then putting it into a blockchain or investing into a cryptocurrency, at that point, we're probably not going to find anything. And another question we get asked a lot is, can you help us with recovering the asset? And the quick answer to that is not without an attorney or law enforcement's help. We can help trace it and we can help identify the facts, but at the end of the day, recovering that is another effort in and of itself. Fraudulent conveyances, we're talking really just we're just talking about fraudulent transfers. We see that a lot in bankruptcy cases where maybe they're trying to hide funds from creditors or receivers and trying to keep them from seeing that they do have some money that they can pay, and they want to maybe save some of that for themselves after the bankruptcy process is over. And then just general theft, people getting their hardware wallets stolen, people finding private keys, and kind of like Chase had mentioned, if you have the private key, you own the cryptocurrency, period. So this is a basic example, and I just want to walk through it because I think it helps illustrate our process when tracing cryptocurrency. So let's just say we have a typical divorce matter, and Jane Doe has hired Chase and I to find out they're going through divorce. Her husband, John Doe, she thinks he's hiding money from her and doesn't want to pay her alimony. And she said, I think he's hiding money. In fact, I think he might even be putting money into cryptocurrency. So let's just say we obtain their bank accounts through either subpoena, through the court process, or we obtain it because it's a joint account of Jane and John's. And we start looking through the account and we see that he sends money to a Coinbase account. So now we know that John has put money into Coinbase and he probably purchased cryptocurrency. So we then ask to get his Coinbase transactions through subpoena. We find out when tracing the Coinbase transactions that he had purchased Bitcoin and moved that Bitcoin into an unknown wallet. And this is by tracing it through the blockchain. And we also see that he put it into what appears to be a Binance account. So now we have evidence to say that he owns a Binance account. So we go back to the attorney, we go back to the court, and we say, well, now we need a Binance account that John has. We get that subpoenaed. We see that from his Binance account, he sold the Bitcoin and put the cash in an unknown bank account that he has. Now, this is just a basic example, but this would show how A leads to B, leads to C, and we can now obtain unknown bank accounts where from there, maybe the money is in a savings account, maybe from there it is being diverted to another individual to hold the money until the divorce proceedings are over. Maybe it's just sitting there. And that's just one way he was trying to hide funds, or maybe he wasn't trying to hide funds at all, it was just an unknown account. But that's one way that we would trace it. So the challenges that we run into, some of the challenges like Chase had talked about, ATM, paper wallets, cold wallets being kind of like a hardware wallet. It's essentially a USB device that isn't connected to the internet. Essentially, that's the best way to look at a cold wallet. And a nano ledger is a great example of a product that is a very popular cold wallet. Paper wallets, you can walk up into gas stations. I've seen them. You can go into a truck stop and you can see a Bitcoin kiosk and you can put cash in and get a Bitcoin piece of paper that says you now own Bitcoin. Now, how does that work? It's very similar if you were to go into a casino, play a slot machine, and then you get a ticket out at the end and you cash out that ticket. And now you have a ticket that's worth money and you have to go somewhere to cash that, right? It's very similar to that. You now have a paper wallet that you can use that wallet address to send money from that paper wallet, or send Bitcoin or cryptocurrency from that paper wallet. But because it's paper, because it's cash, it's very hard to trace, right? So if someone goes and puts $100 in a kiosk and gets a piece of paper, it's very difficult for us to know that even happened. Now, there can be witnesses, there can be cameras, we can identify that, okay, they did that. You can subpoena those kiosk companies. And a lot of times if it's over a certain dollar amount, that person purchasing the Bitcoin through those kiosks has to provide them with some kind of personal identifying information, whether it's driver's license number or a phone number of some kind. They have to provide that if it's over a certain dollar amount. So that's helpful as well. It is pseudo-anonymous. So the blockchain, it's public but not linked. So yes, every transaction that happens in cryptocurrency, we'll just say Bitcoin, every Bitcoin that's transacted, you can view it in the blockchain. Does that mean it attaches Brett Johnson's name to it? No, it doesn't. You'll see a bunch of hashes, a bunch of wallet numbers, and you do not know who that's related to. Now, there are ways that you can link it, maybe to certain individuals based on activity that you know is linked to a certain wallet, that now you see other activity happening out of that wallet. That's one way we can do it. But it's almost like looking at a general ledger where there is no chart of accounts and none of the accounts have names. They just have really long character names, like 64 characters, and you have no idea what that means. And the only person that would know is that company or organization. So it's not unlike that. Converting to other assets. So that's another issue that we run into, is people buying Bitcoin and converting it to another cryptocurrency that's on a different blockchain. And now we're trying to trace within multiple blockchains. That becomes a problem. Or maybe they're taking a cryptocurrency and actually buying an asset with it, and they send that money to someone else's wallet. And let's say they get a yacht in return. We just don't know that that happened, right? Maybe we don't see the yacht in the blockchain. We see that that other person received Bitcoin, but maybe we don't know what they got in return. Cross blockchain transactions. Thorchain is probably the most popular service that provides this, where you can actually have transactions where one person has Bitcoin and another person has Ether, and those are operate on two separate blockchains, but Thorchain allows that to occur, and that makes it difficult for us to trace. Mixers and tumblers, I'll talk about that in my next slide. And then privacy coins. So those are basically operate on private or their own blockchain, and they're more private. So you can't necessarily see all of the transacting that occurs within those blockchains. So mixers and tumblers, going back to the same example that I talked about before. This is an example of how someone could use a mixer tumbler. Now a tumbler is a paid service, so you will pay them a percentage of your cryptocurrency, or I think they might even take regular payment of cash, but or of money, but fiat money. But in the same example we talked about, John Doe puts money into Coinbase, and then from there, there's other players involved. So you got person A, person B, and person C. Now, if John Doe wants to pay person C, but doesn't want people to know that he's paying person C, all these other individuals are putting money into what's called a mixer or tumbler. Now, everyone puts their Bitcoin into there, and what that service now does is they will mix it. See the little animation that I put in there? That's the mixing animation. They will put it in the mixer will mix it up and then dish it out to where it was supposed to go. Now, we can see everyone's receiving money, and now there's this extra person D, that wasn't part of the original input, is receiving some Bitcoin, but we don't know who paid who, because it all went into the mixer and they mixed it up and they dish out the money. So I don't want to say that this has very large implications for money laundering, but it's probably called a tumbler for a reason. And it's it's not illegal. And could people use it for illegal purposes? Absolutely. But it's not an illegal thing. at this point. Like having a mixer or paying a mixer to do this is not illegal at the moment. So ultimately, the goals of investigation or tracing are trying to tie the transactions to a person or persons, right? We want to be able to say, okay, we saw this come out of this person's bank account into, we know that they bought this, and then we traced it to a wallet. And ultimately, we want to be able to see if we can actually tie those transactions to an actual person, because the blockchain doesn't tell you that, right? We want to identify the current resting place. Sometimes that's all it is it got moved into a wallet, whether it's an online wallet, a hardware wallet, or a paper wallet. We were able to find that that's where it's currently at. That's where it's currently sitting. And ultimately, we want to be able to provide these facts to the stakeholders, to attorneys for litigation purposes, or to insurance companies for insurance claim purposes. And ultimately, and if necessary, calculate potential damages that may have occurred. You can imagine if someone took Bitcoin and converted it to another cryptocurrency to conceal it, and then that cryptocurrency lost value while Bitcoin increased in value. Well, now there may be an economic damage that was incurred because that person tried to hide it. Now they lost the value that would have been there but for their actions, right? So there's a lot of implications that can come in there. There's a lot of calculations potential calculations that can be performed. Chase has a case example that he can walk through. Amy, if you can give control back to Chase, he can go through that.
All right, so here's one of the examples that we got a while back. This is a divorce case that we worked on. We started off by reviewing the bank accounts. And so you can see there's 3 different bank accounts that we had received and we were reviewing. And then we're able to see funds, US dollars, going into Coinbase. And so from there, we then subpoenaed the Coinbase information. And after reviewing the Coinbase information, we're able to see that not all of the funds that went in necessarily came back out in US dollars. So we saw that from this Chase bank account, there was almost $10,000 going to Coinbase. From Wells Fargo, we saw there was $2,000 going into Coinbase. We also saw $26,000 as well. So there's 2 different ways that this money was going to Coinbase. This $26,000 was used to purchase cryptocurrency directly, and then cryptocurrency went into his Coinbase wallets. But also some of the United States dollars, the fiat currency, just got deposited into a USD wallet in his Coinbase account. So he had almost $12,000 in fiat currency in his Coinbase account, but he also had this $26,000 of cryptocurrency that was purchased directly. So you can see it quickly gets really complex here. And that's why it's important to have an understanding of how these work, because you can't just say, all right, 12,000 plus 26,000 went in, and as long as we see all that coming out, then we're good. You can't treat it that way because there could be changes in value of the cryptocurrencies. And so while we were doing this, we also noticed that there is some sales of cryptocurrency from this account that went to these bank accounts. We also saw some other additions added to this Coinbase account from somewhere that we don't know. So we know there's also another source of funds that's helping fund this Coinbase account. So that's something that we'd want to look into. And now going into the cryptocurrency side, it's difficult to show both cryptocurrency and fiat currency in the same graph. So this is really the best demonstration that we could give. From the Coinbase account, he then sent cryptocurrency to another exchange and kind of traded back and forth cryptocurrency between these exchanges. And this other exchange in this case was GDAX, which is just an offshoot of Coinbase. But he's transferring cryptocurrency between these accounts, as well as transferring fiat currency. And so US dollars. So then we now have this other exchange involved. You can see this cryptocurrency, he basically sold all the cryptocurrency from this exchange. He gave US dollars from this Coinbase account to here, as well as the cryptocurrency. So all this information right here used to purchase cryptocurrency and fund the Coinbase account, then got transferred to this other exchange. And then from this exchange, some sales went to Coinbase, sold approximately 24,000 of crypto, and then transferred that back to his Coinbase. And there were some other United States dollars, fiat currency in there as well. So he transferred a total of 28,000 back, and then transferred some of that to the known bank accounts. However, we know that not all of the cryptocurrency was transferred or sold to the accounts that we had access to. So that's what this extra little area over here stands for, external wallets and addresses. These are other cryptocurrency addresses that he sent cryptocurrency to. And so all these cryptocurrency lines, we could have another diagram representing the flow of cryptocurrency, but this is the easiest way to integrate both fiat currency and cryptocurrency into one diagram to kind of help show how complex the flow of cryptocurrency and fiat currency can be, and why it's important to understand both for situations like this in divorces or while doing investigations. It's important to have access to different types of information that could be helpful. And so for this one, like I'd mentioned, start off with the bank accounts, got the Coinbase accounts, we traced the cryptocurrency and the fiat currency. We identified all the addresses involved in the transactions. And then we also identified current balances in the accounts to help quantify how much cryptocurrency and fiat currency that was present at the time of the date of service in this example. And Amy, I see we do have a question. So the one in the chat, it says, I'm under the impression that there's a maximum number of Bitcoins. Is that true? And are others built the same way? So there is a finite number of Bitcoins. It's 21 million Bitcoins. And so other blockchains do exist the same way. Other cryptocurrencies do have limits, but there are some that don't have limits. For example, Dogecoin is one that doesn't have a limit. There's an infinite number of Dogecoins that can exist. A lot of blockchains do have limits, but there are a lot that don't. So that's the quick answer to that question.
The other one here, Chase, from a forensic perspective, is there much difference between tracing transactions on the exchange versus DeFi? My short thought process there would be, I don't think so, but I don't know that we've ran into that situation yet.
And I think just the difference would be the tools that we utilize for doing the tracing. But a lot of the legal aspects and stuff, we can still utilize the same subpoenas and stuff like that.
Another question, how will the Taproot upgrade impact the traceability? Minimal impact or pretty significant?
I'll touch on that one.
I'm not familiar with the Taproot upgrade and how that will impact it. So that's a great question. I guess we'll find out when it happens or when we deal with it. And to be honest, that's kind of how this has happened with us in conducting these investigations. Is everything is kind of happening in real time, and we're dealing with situations as they occur. So that is another challenge with investigating and tracing crypto.
And the last question there is, we have some nonprofit clients that are asking whether they should accept cryptocurrency as donations. Do you have any thoughts or suggestions on how to counsel a beginner level client on this consideration? One thing, as I mentioned throughout the presentation several times, understanding how the blockchain works, understanding the difference between public and private keys would be a good way to kind of get that introduction. You don't need to go into the nitty gritty of the cryptography and all that information, but just understanding who ultimately has control and access to that cryptocurrency would be a good way to start.
And lastly, are there companies that track the change in value for tax reporting on sales? And I believe the exchanges will track a lot of that. And I believe there's websites out there that will maintain that information as well.
And there are websites as well that you can input your transaction information into, and it'll calculate tax liabilities and stuff like that. And with those, you don't give out your private key. So be wary of what information you give out with cryptocurrency. Like I mentioned, private keys are important, but when you do those tax websites, if it's asking for a private key, do not give it. There's something not right with that website, but there are legitimate websites where you can put your transaction data in and it'll calculate the liability for you.
No, that's our contact information. If you have any questions for Chase and I, please email, call. We'd love to talk about this stuff. If you have specific concerns, feel free to reach out. And thank you for attending.